Hey, this is your boy Kofi Thompson here, and we are back for another financial education video to help you guys accelerate on your financial goals and build wealth and create the legacy that you guys are aiming for. So today I want to talk about common questions when it comes to life insurance and also common lies out there about life insurance. This is a pretty big area in the world of comprehensive planning, and I often talk to a lot of clients about this stuff. And yeah, these are just like common things that come up. So I want to kind of clear the air for you guys and give you guys a professional advice on this stuff. So the first thing that I usually comes up a lot is when looking at life insurance, a lot of people ask what are the different types of life insurance and how do they differ. So overall, there's going to be really three main types of life insurance: term, permanent life insurance, and then or whole life insurance, and then universal life insurance. So term, whole life insurance, and then universal life insurance. I'm just going to stick to whole life insurance and term insurance for this video. Universal life is pretty complicated. I'll probably dive into that in another video. But just for kicks, I'll explain the difference between whole life and term insurance. So the best way to understand the differences between term insurance and whole life insurance is looking at a house and understanding the difference between renting and buying a house. So term insurance is going to be like renting a house. You don't actually own the policy. It'll actually run out after a certain time. Typically, if you are gotten the policy through work, you're going to have that policy until you decide to leave that job or you retire. Or it may be like if you've gotten that policy privately, it may be like 10 years or 20 years or a 30-year policy or like annually renewable policy that you have over time. But at some point, that policy is going to run out. So you don't really own it. Another portion of that is that if you are renting a house, you are making payments into that policy, but you're not actually getting any equity build up. So in a whole life policy, you're going to actually get cash value build up. So in a term policy, you're not going to get any type of asset build up. You're not going to have something to leverage down the road. It's what is called pure insurance. So you can think of term insurance as this very similar to health insurance or auto insurance. If you don't actually have a triggering event, aka death, you're not going to get a benefit for that policy in general. And so with a whole life policy, it's like purchasing a house. You have that asset, you own it, and that's there for your entire life, as long as you make the mortgage or premium payments. In addition to that, you also build up a cash value, and you can think of that cash value like equity in your house. That is your, equity that you have or cash value. You can take money out of it, you can borrow from it, you can take a loan off of it. It has many different, tools because it's an asset that you actually own. Now, there's a lot more aspects to, differences between term and permanent, but I just want to leave it there to give you guys, a short, quick explanation on the two. A common question or a common lie that I actually hear oftentimes is that, term insurance is cheaper. So it actually depends. One, term insurance is very different from whole life insurance, and they both have different, benefits and withdrawals, and they're both generally applied in different situations. If someone wants to build up an asset, they're probably going to utilize whole life insurance. If someone is just looking for death benefit coverage, they're probably going to look for term. But I often, get the, opinion out there oh yeah, you hear a lot of people talking, term insurance is definitely cheaper than whole life insurance. Well, great way to look at it is like this. So, one, if you have something that you're paying for but you're not getting any type of benefit from, unless you have, something happen, that is technically a liability. Because you're paying into it and you have to make those payments, but at the end of the day, if you don't actually if you don't actually pass away, you're not actually seeing the benefit. And the reality is only about 3 to 4% of term policies actually end up paying out because most people outlive them. But if you have something where you're paying into an extra, you're actually building up value, you're actually getting a return on the money you're putting in, that's going to be classified as an asset. And I'm sure if you're watching this video, you probably, it's not the first financial video you dove into. Maybe it is, but you may have read Rich Dad Poor Dad, assets over liabilities. So if you, for example, pay into a whole life policy over, 20, 30 years, you're going to have cash value built up in that policy that you can leverage and you can do things with. So saying term insurance is cheaper than whole life is like saying renting is cheaper than buying a house. Yeah, initially it's a lower cost initially because you don't have to pay for, property taxes, you don't have to pay for repairs, different things like that. But if you look at the, average, wealth of someone that's been a homeowner over a renter, that person that's a homeowner is going to have more wealth because they're building up an asset over time. And that's the reality of it. The second thing that I sometimes hear, and this is again like a very common misconception of life insurance, or life insurance lies, what I call it, is that, companies keep your cash value when you pass away. So this goes back to really the understanding of how a whole life insurance policy works. So over time in a whole life insurance policy, you're going to make premium payments. And initially, a lot of those premium payments are going towards the cost of insurance. Just like in a house, the mortgage payments go towards the interest initially. So it takes some time to build up your cash value. But after a certain point, generally if you're working with a company that has a strong dividend rate and has a great product, at some point your cash value is going to equal your premium payments, and then it's going to start to exceed that. Well, the death benefit is actually with a policy that's structured so the dividends buy more death benefit. The death benefit's generally going to be composed of the cash value and the actual initial death benefit that you purchased. So you may have purchased a policy that's initially $1 million. And again, the caveats are that this is with a good company. You've worked with a great advisor that has provided you a good product. You may start off with $1 million in your policy at face value from day one, and then over time that policy value is going to build up. So after 10 years, it may be 1.5 million at that point. So when you get paid your death benefit, and let's also mention, I'm also going to mention that the cash value in this $1.5 million policy has now reached $500,000. So when you pass away, you're getting paid your death benefit, plus, any of that accumulated cash value as well. So the company doesn't just keep your cash value. You're actually getting paid, above and beyond of what the initial face amount of that policy was. And again, you do want to work with a great company. You want to work with an advisor, someone that's going to give you, the best solution for what you're looking for. But if you go with a good company, then you really, don't have much to worry about because you are going to get paid out, multiple more of what you've actually put into the policy in addition to that death benefit. Another piece that I want to talk about is, does the company actually matter with who you go with? So a lot of people, just through miseducation and misinformation out there, don't really know that there's various differences between life insurance companies. The reality is not every single life insurance policy is the same. And generally, what I say is everyone understands the costs of things nowadays, but not everyone understands the value of things. So when it comes to life insurance, you're going to have, in my opinion, two main things that you really want to pay attention to if you're looking at a company. The first is understanding that there's two main structures of how a company is structured. You could either have a stock company or you can have a mutual company. So a stock company is going to be a company that's publicly traded. This is a company that has stockholders, and they publicly trade them on the markets like the S&P 500, so on and so forth, and they have investors. So when a stock held company, makes various types of decisions, goes around doing their business, all those different things, like they're doing it at the benefit of their stockholders because they want to see that share price go up, essentially. So if you're making a decision and you're facing, hey, I have to make this decision for my policyholders or I have to make this decision for my stockholders, you're probably going to side toward your stockholders. So just initially, there's like a conflict of interest there. Like, how can you provide the best benefit for the clients you serve if at the bottom line you have to, provide your best benefit for your stockholders? And I'm sure, all of you guys have seen what, has gone on in very large corporations over the last, 20, 30, 40 years, really being focused on shareholder profits. That's just the reality of it. The other type of company is a mutual company. A mutual company is not going to be publicly traded. It's actually privately owned. And the people who own mutual companies are actually going to be the policyholders. So if you purchase a policy through a mutual company, you are now a part shareholder of that company. And you can think of it very similar to like how like a credit union works. So because mutual companies do not have shareholders, they are generally going to make, or they are, not generally, they are going to make changes and they're going to make choices that are in benefit of their policyholders, because those are the people that actually own the company, and those are the people that they, at the last end of the day, that's who they need to truly serve. So frankly, in my opinion, like, you should be going with mutual companies just naturally, because like if you are looking for a company to work with, go with a company that has your best interests at heart at the end of the day. So that makes a huge difference. And then another thing that I think is extremely important as you're looking at, types of life insurance coverage, and this really goes back to like if you're particularly looking at whole life or permanent life insurance, it can have some benefits if you're looking for term, but this is particularly if you're looking for whole life. So if you're looking for whole life, you're generally going to want to go with a company that, one, has a very long financial history. There are some companies that have been outstanding since the mid 1800s. So if you're looking at a product that's very long term, like, you want to go with a company that also has a very long term history. Like, you don't want to go with a company that just started 20, 30, 40 years ago, ideally. You want to go with one that has a good track record. And second, you want to go with a company that has a good dividend record as well too. So dividends are essentially like interest you get on your savings account. That company, well, what it technically is that company is actually paying out profits to their shareholders. So if a company has a good dividend rate, you're going to get paid a dividend every single year that's going to help build up your cash value over time. So it's like the difference between putting $1 in and getting like 10 cents, or putting $1 in and getting like, $1.20 back. So it makes a huge difference long term because of, as you guys know, compounding, to have a company that's paying dividends consistently. So again, this really applies more if you're looking at like whole life insurance as opposed to term insurance, but going with a company that is mutual and going with a company that has a strong dividend rate can really make a huge difference long term for you, overall. And the next, lie or huge misconception that I want to tackle here, the next and last, is permanent insurance an investment? So there's oftentimes a lot of life insurance agents out there, and I want to distinguish an agent from an advisor. An agent is, just trying to, at the end of the day, sell you something, not really understanding what your needs are, not really understanding, okay, what is truly best for you. An advisor will go through and understand your situation comprehensively. They ask you questions and they find a solution that's best for what you're trying to accomplish. A lot of agents out there will be like, hey, like, you should invest in permanent life insurance or whole life insurance in particular. So this question is kind of two-sided. So permanent insurance can be an investment, but it is only going to be an investment if it's tied to an index, like you may hear Index Universal Life, or if it's variable and it's actually invested, like Variable Universal Life. But pure whole life insurance is actually not an investment. It is an asset, which is very different, an asset, so it does accumulate value and you are able to, borrow off it and utilize it down the road. But an investment is something that actually first has risks to it. You can actually lose your money. In a whole life insurance policy, you have guaranteed cash value, so you can't actually lose your money due to market fluctuations. You can lose money in an index universal life policy or in a variable universal life policy. And then two, an investment, and this is getting a little complicated, guys, but the investment is actually regulated by the SEC. So that means that the person that is selling that investment to you or providing that investment to you has to be registered with the SEC, and that thing is registered as a security. So whole life insurance is not regulated by SEC. It's not a security, so it's technically not an investment. Again, it's still an asset. It's still something you can utilize down the road, and it grows over time. But just like your savings account is not an investment, whole life insurance is also not an investment as well too. I hope that this information, cleared up a lot of answers for you guys and was really informative. You guys can, take this knowledge and now make some better decisions for you guys financially. If you have any questions, please feel free to reach out, comment, like, subscribe, all the great things. It's your boy Kofi, and I will be back soon with some more financial knowledge to help you guys get to the next level.